Good evening, ladies and gentlemen. Welcome to Rowley Turton's latest webinar on issues and topics which we hope will be of use to our clients and perhaps potential clients and everything to do with financial planning. Today is a rather special one because today, of course, the Chancellor of the Exchequer, Rachel Reeves, has sat down only a few hours ago, having given her second budget of the Labour government. Now, I should say that Scott and I are both chartered financial planners here at Rowley Turton. We have both had careers over several decades in financial planning, and we've both seen budgets every year of those decades. In fact, there was a spell where there were two budgets a year, and every single one of those has been eagerly awaited and anticipated, and speculation is always rife, especially by us, as to what's going to appear in a budget before it actually does. But this year has been even more so, much more so, in fact. And you'll all have seen in the papers and in the news broadcasts, and you'll have talked amongst yourselves about the big bombshells that were going to drop on this particular budget. And we weren't immune from that, even though we're quite cynical about these things. We indeed thought there were going to be some quite big bombs dropped in this budget. So, what was the conclusion then? Well, I think that's best summed up in a couple of phrases. It was disappointing, but not dramatic. So just to expand on that, in terms of not dramatic, well, there are changes, and we're going to go through the changes with you, but there were a lot of bullets that were dodged, a dog that didn't bark, and there were things that we feared might happen that really haven't. So, for example, there've been no big changes to the way pensions work, and in particular, no changes to the tax-free cash allowance, which we were speaking about a lot. There've been no big changes to inheritance tax, something that gets people very hot under the collar. It's a big topic for our clients, certainly. And also, no big changes, so no sweeping changes to the way tax works, the way the income tax and the tax we pay on our earnings works. There are changes, which we're going to go through in a little minute, but no big changes throughout. So not dramatic in that sense. I also said it was disappointing. Well, disappointing in the sense that the government will have told you today, and the newspapers will have told you it was their intention that this budget be all about growth, economic growth for the UK, something we sorely need. And when we say growth, what we mean, it's pretty simple, is the wealth in the country growing and improving. So everything we do when we go to work and we create wealth for ourselves, our employers, and build wealth and build the economy, that all factors into what we term economic growth. Governments of all colours will tell you that growing the economy and introducing growth is a key objective, and especially now when economic growth is a bit stagnant. It's sometimes a bit controversial because the way to generate growth is often by means that appear to be favouring the better off. So, because you're encouraging investment, you're wanting people to put more money into the company, the people who are perhaps already wealthy. And there are ways to suppress growth as well, ways to discourage people from investing, encouraging people from taking risks in the economy. So we were looking out today for some encouragement of that growth and maybe lifting some of the discouragements. But unfortunately, when I say disappointing, what I mean is that doesn't really seem to have happened. In the office today, we've looked at the budget and just realised that there isn't really a lot that for our clients, and quite a few of our clients are entrepreneurs, business people, people who do grow the economy. There's not a lot in it for them, and some discouragements in actual fact. So I suppose another way of rounding out the budget today is to saying it could have been worse. We were expecting a really big and dramatic change, and there haven't been a lot of that. But of course, there are some things to talk about, and we'll go over the first of those now. Next slide, please. Oh, just a bit of housekeeping. In this webinar, the microphones are muted, so we can't hear you or see you, of course. And there's a question and answer feature on the screen. Please type in any questions you have about anything we're speaking about, and we'll go through those at the end. Also, this webinar is recorded, so we're going to send you an email of that in a day or two, so you can watch again at your leisure or pass it on to friends. And that's it for the housekeeping. So moving on, there's a few caveats that nothing we say in this webinar is advice. So if you want us to help you actually take some action on your financial planning, please get in touch. So this is a picture of us, just in case you can't see us there at the bottom of the screen, smiling for you, how the budget would affect you. So let's go on first. Fiscal drag. I'm going to take this first before I hand over to Scott. And fiscal drag is something I want to emphasize to you because it's something we're going to be talking about a lot. And just to explain what fiscal drag is if you think back, those of you, most of the people watching this will have been working for most of their lives, some decades at least, don't have many young clients. And if you think back 20, 30 years and remember what you're earning then, well, obviously the tax bands and the allowances were in proportion. And it's often overlooked that inflation creeps gradually up and up each year. And what we earn and the wealth that we have in our homes and our investments and our pensions creep up and up every year. And if the allowances and the benefits don't increase in proportion, then gradually and gradually and gradually, the tax we pay in our investments and our homes and everything else increases and increases. So what's happened in recent years is, and this is called fiscal drag, is that our earnings have gone up, we hope. Inflation has certainly gone up, and most people's wages have gone up in proportion, and house prices, of course, and things like that, and investments go up each year. But if the tax allowances don't increase in proportion, then more and more and more of that wealth and those earnings are exposed to the taxes. So effectively, the tax goes up and up and up. Now, on the screen at the moment, you'll see some of the key tax bands that we all, or most of us, pay attention to. The personal allowance, that's the first bit of your earnings before you start paying any tax. That's been at 12,570 for over 10 years. And the basic rate tax bands, which is the 20% band that we pay on our earnings, and the higher rate threshold have likewise been static for years and years and years, even though our wages and our earnings have gone up by a few percent a year, according to inflation. So more and more and more of our money have been taxed. And so therefore, even though the government would quite truthfully say the rates have remained the same and they haven't increased taxes on working people, which was their bold claim on this budget, in actual fact, the tax has gone up and up and up as a proportion of your earnings. So this fiscal drag is a really important point, and it applies not just to our income tax personal allowances, which is what's on screen at the moment, but also to all the other tax allowances for inheritance tax and capital gains tax and lots of other things. So that's a key measure the government have employed in this budget to increase tax. Some people call it sneaky or surreptitious. I don't know if it is really, but it's certainly something that people notice less than suddenly saying, well, we're going to charge you an extra rate of tax. It's just quietly, the tax rate goes up and up. Having explained that point to you, I'm going to hand over to Scott now, and he's going to talk to you a bit about some of the changes that actually have been announced in the budget, and I'll come back and join you in a little while. Scott.
Cheers, thanks, Martin. Just carry on that fiscal drag point just for a moment. Then it's the classic what if. So if fiscal drag had not been employed by both this government and the previous government in its various incarnations, then this is what we think the personal allowances would have been in a couple of years' time. 16,000 for the personal allowance. Higher rates tax wouldn't have kicked in until 65,000, and the additional rate band would have been at about 195,000. And this is based on a 3% inflation from when rates were last increased to when we think they might start to be increased. So this is just an indication. So as Martin says, fiscal drag is where you've had a pay rise, but they haven't increased the bands or the allowances, and therefore that your tax effectively goes up. This is probably best illustrated for those on a state pension, where the state pension goes up, but the tax bands or personal allowance hasn't. And now people are paying tax, albeit they don't necessarily feel much better off. One second. Does it work from the government's perspective? It works very well. So effectively, over that period, which is heading on for almost 10 years, it's calculated that the government will get in for the average working person or full-time employee on about £38,000 when until 2021. The government are probably earning an extra £1,000 in tax per worker or employee or person on that point. So it's quite effective when you multiply that up by the number of people in the economy. And obviously it's cumulative because they've earned more money every year that they've done this. So looking at lower taxes, national insurance, good news is there's no changes to any national insurance rates. Employers in particular will remember that last budget, there was an increase to the employer's NI rate, and we're still feeling the impact of that. As far as we can tell, the employment allowance, which is a kind of de minimis level at which you start to pay national insurance, kind of credit you get before you have to start paying national insurance government. As far as we can tell, that's unchanged from the current year's figure of 10,500. And we would say that's possibly yet more fiscal drag, i.e. that your national insurance bills will go up because wages go up, but the credit you get from the government, it hasn't gone up. So again, that's a small change to businesses, but it all adds up. 1 second. I'm jumping around a bit. 1 second. Here we go. Capital gain. Sorry, apologies here. I should do this the way around because the mouse is very sensitive, I think. 1 second. 1 second. Does not want to move. 1 second. Small technical hitch there. There we go. There we go. National insurance. Here we go. Oh, capital gains tax. No changes, so that's good news. We were a little bit concerned about the CGT rates could increase. There is a small point on business asset disposal relief, entrepreneurs relief as it was, and we'll come on to that later. But again, as far as we can see, the capital gains tax allowance remains at 3,000. Again, so that's a small element of fiscal drag. If inflation was applied to that, we'd expect it to be 3,100, around that kind of figure. So it's capturing more and more gains every year just by not increasing allowance. In fact, actually, with capital gains tax, it's arguably worse because the capital gains tax allowance was cut over a number of years. So not only is it not increased by inflation, it's actually been cut, which was generally by the previous government. Inheritance tax, the good news is that there's no changes to the rates. We were slightly worried that there would change to the rates and the allowances, and the 7-year clock might get extended. Some of the tax planning measures we use, we were chatting in the office the other day, and we're worried that they could be under threat. So from one perspective, that's really good that they haven't changed. There's a couple of things to be aware of. Again, we're back to this fiscal drag point. The inheritance tax bans, which were already going to be frozen to April 2030, that was last year's budget, and governments like to get the bad news in early and spread this bad news out in years so they don't get in trouble for doing it in the future. And they've extended that freeze for an extra year to 2031. And this is something that we're going through with clients a lot, that if you were to assume the inheritance tax bans increased by inflation, a lot of people don't have an inheritance tax problem because their estates are less than $1 million and they're spending some, so that kind of balances out the growth a little bit. But you still expect the price of your house to go up. Hopefully the value of your pension goes up if you're not yet retired, etc. So on a real terms basis, your estate might stay comfortably below £1 million for some clients, but in an absolute terms basis, we're seeing that those numbers would be expected to increase. And that gives a inheritance tax problem, which is purely the result of fiscal drag for some clients. And that's one of the things that for the last few months we've started to illustrate with clients, how that even if we don't have an inheritance tax problem today, they might have one in the future, even though technically they are no better off and they're no wealthier, which again is a bit of an issue. The only other couple of points is, this is from the last budget, that unused pensions and possibly death benefits, depends on how they're phrased. Most death benefits seem to be excluded, but some of them may still get caught, are going to be brought under the IHT regime from April 2027. We have done a couple of points on this. We've done a IHT and pensions calculator that we have on our website, but also we'll send you the link to if you just drop us an email, and that allows you to put your details in, so all your assets, including pensions, and it will clearly illustrate what the potential inheritance tax change is based on today's values from April 27, and that's quite frightening. I'm sitting with clients and we're seeing 40,000, 60,000, 200,000 pound inheritance tax bills purely because of this change to the rules. Finally, some good news is agricultural property relief and business property relief. They're now going to be transferable between spouses. There was an issue previously on the previous budget that if these allowances were effectively lost when one of you died and you left it to your husband or wife or civil partner. So there is some good news on that, and we're quite happy to chat to people about those kind of reliefs and how that affects people. For directors, employers, small business owners, etc., some good news. Corporation tax unchanged, albeit it did increase previously. Not so good news on dividend tax. There's an extra 2%, albeit not on the additional rate, with effect from April 2026. Employers' national insurance, that is unchanged, which is good news, albeit decreased before, and the point about the employment allowance. Minimum wage for anyone employing, especially younger people, is increasing by between 4.1%, which isn't too bad if inflation is 3.8, it's kind of in the right ballpark. But for the 18s to 20s, I think it is increasing by 8.5%. And that is on the top of an increase for that age demographic of about, I think it was 18%, 18 something last year. So that's quite an increase in the cost of employing young people. There's just some argument that goes completely against the Chancellor's supposed growth agenda. If you make hiring young people very expensive or relatively expensive, then that's not going to help businesses hire young people. So that's an issue. Capital gains tax on sale of business under what's called business asset disposal relief, previously called entrepreneurs relief. That's now being taxed at 18%, up from 14%. Now, to be fair, that was in the previous budget, but it's just a reminder that this is happening. And again, I mentioned before about business IHT relief, about it being transferable between spouses, which is good. Again, entrepreneurs relief, just to touch on it again, gone from 14 to 18%. So this is if you sell your business. And previously it was 10%. Back in the day, it was 10% on 10 million. We've now got £1 million band. And again, so that allowance that previously was 10 million, admittedly some years ago, was then cut to £1 million, and the £1 million band has been frozen. So again, if your business last year was worth £1 million, you would have benefited from business asset disposal relief on the whole £1 million. That business, even with an inflation increase to £1,040,000, is going to be suddenly, it's going to be, you're going to be taxed extra on that 40,000. So that's a factor. So savers, they've been quite affected by this in some ways, well, a couple of ways really. And there's a lot of news about the cash ISA allowance reducing from 20,000 to 12,000. That's from April 27. Again, this government and previous governments have adopted a policy of kind of delaying the bad news. So they announce something today, but it doesn't actually come in for a little while. That allows them mathematically to show the impact of that policy in terms of Office of Budget Responsibility projections. That works well for government borrowing figures, etc. But they don't feel the immediate pain because there's a disconnect between them announcing something and it happening. And then when it does happen, they can legitimately say, well, hang on a second, we told you about this 2 years ago. And so therefore it softens the blow. It's still an impact, but it's quite a clever government strategy. In terms of the change, it's worth pointing out that it doesn't affect the over 65s, which for our clients tend to be older is probably a good thing. A couple of comments on that. It's clearly a political decision. Older people tend to vote more than younger people. So if you were cynical, you would say that it was clearly a political decision to exempt older people from this change. The age 65 seems somewhat of an outdated concept, given that state pension age now is 67 going up to 68. So would have seemed more sensible to start into state pension. As financial advisors, I think it's fair to say that the financial world is incredibly complicated. Tax is incredibly complicated. And the government having lots of different ages for things does not make life easy. So our view is if you were going to have a different age exemption, and I question the value of that, then I would have thought that age would have been better tied to state pension. From a slightly selfish angle, as somebody who's luckily under 65, our view is that does discriminate against the kind of business owners element of our client bank who might not want to invest the money necessarily, but would still want to save it tax efficiently. They're limited to 12,000 in a cash ISA, where somebody over 65 can put 20,000 in a cash ISA. So it just seemed a bit of a weird choice. Worth pointing out that the overall £20,000 ISA allowance is unchanged. So what that means is if you're under 65 and today you were paying in £20,000 into your ISA, in the future, as I say, from April 27, you'll still be able to pay 12,000 into your cash ISA, but if you want to fully utilise the 20,000 allowance, that extra £8,000 would have to go into an investment ISA. For some people, that's fine. For other people, that induces obviously more risk, and that's not something that's not appropriate. If you're unsure whether or not that's appropriate for you, you should obviously speak to ourselves or somebody else and obtain appropriate advice. It is worth pointing out there's no impact on existing ISAs. I think there was some concerns from people that this meant that their existing ISAs would be capped, i.e. they could only have £12,000 in an ISA. No, if you've built up an ISA over many years, we've got clients with 50,000, 100,000, 200,000 pounds, etc. They're not affected. It's just what you can pay in moving forward. There's a small point on lifetime investment ISAs, which are generally for younger people saving for a house and other factors. That is to be scrapped and or replaced. There's a consultation period, so we don't know what it's going to replace with, which isn't very helpful. But they're claiming that it's going to be simpler. I think we'll wait and see on that point. And finally, savings income tax rates have increased 2%. So if you're currently a basic rate taxpayer paying 20% on your savings, that's now going to be 22. High rate taxpayers, it's going from 40 to 42, and additional tax rate payers from 45 to 47%. That is just obviously unfortunate, but is also a reminder from our perspective is of the value of ISAs. So you should be putting your savings, make clear the ISAs still remain tax-free, so it's a savings outside an ISA. So in a normal bank or building society account, fixed rate savings bonds, something like that, just to bear in mind. Pensions, well, again, pensions mixed bag, mostly unchanged, which is something. Again, we've got this still element of this fiscal drag, the allowances, which in simple terms for a lot of our business owner clients is £60,000 what's called annual allowance, maximum you can pay into a pension. On one hand, that is very generous, and I think it'd be difficult to say that it wasn't very generous. However, again, it's still not increased. So there was a big increase a couple of years ago, so we're very grateful for that. But from where we are today, it's not changed. I do need to read the legislation carefully because the 60,000 figure was possibly a temporary figure. We haven't seen anything to say it's changed, but I do worry that it might be reduced. So I would take advice before going ahead on that. But I think this year you'll be fine. The more worrying bit was that salary sacrifice has been capped at £2,000 per annum. Again, this is a consultation. It's going to come in. They have been a bit hazy on how they will police this. But the salary sacrifice is whereby you offer arrangement for your employees, or if you're an employee, your employer offers you an arrangement where effectively you technically take a lower salary, but as compensation for taking that lower salary, your employer makes a pension contribution equivalent to that lower salary amount. So I was on 50,000 a year, I'm suddenly on 48,000 and the government is paying, so the employer is paying £2,000 a year into my pension. The main reason for doing that is for a national insurance saving for you as the employee and almost certainly for your employer. So that's why it's been done. It does cost the government quite a bit of money in terms of lost tax, so they decided they don't like it. But it's not coming in for at least a couple of years. So there's some argument that if you have got this opportunity to use it, maybe you should use it now. But again, you would certainly need to take advice either as an employee or an employer, because if you're running one of these schemes, you're going to get a big tax bill in a couple of years' time when they effectively restrict it. Tax-free cash, there was a lot of concerns that tax-free cash was going to be scrapped or changed or reduced in the budget. And now, to be fair, I think anyone spoken to us, we were sceptical that that would happen, but some people still wanted to take tax-free cash, and there was perfectly legitimate reasons for doing that. The good news is it's unchanged, albeit I would again point back to that fiscal drag point that the 25% is unchanged, but there is still an overall limit to the amount of tax-free cash you can take. As far as we can see, they haven't changed that overall limit, so it doesn't affect most of our clients, but some clients it will affect. And again, we think this is just part of this fiscal drag agenda that the government has, which is you freeze the allowance. In reality, pensions should go up in value each year, and last year was pretty good for markets, so it generally did. And therefore, in real terms, that maximum tax-free cash figure is getting reduced. So it probably won't affect anybody today, but if I come back to this in 30 years' time, I think a lot of our clients at that point will be affected. So it's a slow burn from the government, but it is a factor. And the big one, which was previously announced, but is worth reminding people of, that death benefits effectively unused pension funds in this scenario really. I subject to IHT inheritance tax from April 27. I mentioned earlier we have a calculator. We can put your details in. We'll give you an instant answer of what we think the likely impact is. So anyone who wants that, just email myself or Martin, and we'll send that over to you. Properties, again, mixed bag really. No changes to the main residence relief rules, no changes to the capital gains tax, that's good, no changes to stamp duty, all things that we've messed around with previously. However, income tax on rent has increased by 2% on all rates. That's effective from April 27. It's interesting that landlords and savers, their rate increase comes in April 27. But for business owners, the extra 2% national insurance that they're going to get charged comes in from April 26. So it comes dividend tax, correction. And then, but again, this is going to be an issue, people. And then we've got this mansion tax, which is between 2,500 and 7,500, depending on the value of your property. We understand that the government are going to re-rate all properties in the top 3 council tax bands in 2028, probably do it a bit before, I'd imagine. So this is going to come in. So we've got some clients who've got some very nice houses, almost certainly going to be caught by this. So that's a factor. So from a general planning angle, you've got to think that your living costs are going to go up quite a bit in a couple of years' time. There's some other points which are relatively minor, I think, in terms of what we do. So we have an issue with venture capital trusts, and that's a specific tax advantage product that we at Raleigh Turton don't typically use. Fundamentally, we've generally viewed them as quite high risk, and generally most of our clients are slightly cautious / conservative with a very small C. And so we've not really felt that's appropriate. But the income tax relief, that's a tax saving you get by taking these things out, has been reduced to 20%. Our view is that for a product that we generally weren't a massive fan of anyway, that reduction in the tax advantage will be bad news for that sector, shall we say. I think the attractiveness of venture capital trust for most people will be much less now. On the electric vehicles, so that driving an electric vehicle as a company car driver, which is very tax efficient. Good news is they haven't changed the benefit in kind rules, which is something. But the government is certainly guilty of what we would see as mixed messages. So on one hand, they have said that they support electric vehicles, and there's a range of grants that are being introduced or extended regarding charging, etc., which is all positive. But then on the other hand, they're introducing a mileage charge. So what they're going to do is some kind of system where the owner or the driver of the car will have to register the mileage. Partly this could just be caught by MOT or normal annual declaration, I suppose, or when you change your car. And then you're going to tax. I think they were talking, 3p a mile for full EVs, and I think it's 1.5p for hybrid vehicles. And that's a rate that they are very keen on increasing in the future, and they have said that that will be linked to inflation. So whereas they don't tend to increase a lot of the bands, they certainly are increasing this pence per mile charge. Small point on employee ownership trusts. This is whereby you can sell your business to a trust for the benefit of the employees. There's generally a big capital gains tax advantage. Well, certainly up to today, there was a effectively you could sell it and pay no capital gains tax, and then your business would be owned by the employees, and you would get the money back from the business. It was a very tax efficient way of accessing the business. It was encouraged by the government in order to pass the business on tax efficiently, but to pass it on to the employees. I think their vision was we would create a series of John Lewis type partnerships where the employees would own the business, which is obviously to be lauded. Again, they seem to be very conflicted. Rachel Reeves has this supposed growth agenda, but then changing this thing which would change the passing on of your business. So currently you get full capital gains tax relief, or you pay no capital gains tax when you do this. They're now saying you're only going to get half the benefit. And there are some issues with employee ownership trusts. So again, we think that kind of probably kills that element for most people. Sugar tax, ridiculous daft for purposes of this exercise, but essentially this is the idea of milkshake tax, expanding the sugar tax that's on soft drinks, milkshakes and stuff. Shouldn't affect anybody here, I'd imagine. Fuel finder, in my view, one of the absolute ridiculous things of government. Apparently the source of the UK's woes is that we don't can't find the cheapest petrol station, despite having the internet and Google and everything else. So apparently there is a fuel finder service that they are launching, which allows us to go online and find the cheapest fuel. Absolutely ridiculous, but apparently it will save us £40 a year. I'm not sure how that goes anyway to offsetting the £1,000 a year that we're losing from fiscal drag or just on the income tax bands, etc. But I suppose every little helps. Who's affected? That's it. I did skip a slide earlier about the tax. I'll just cover very briefly, but this is this 2%, which I have covered separately, which is on savings, dividends, and rent. But now I'll pass to Martin about who's affected most.
Thanks, Scott, for taking us down a whistle-stop tour through the announcements in today's budget. So, as I said at the beginning, not a lot of drama there, really. Most of them are sort of tweaks and adjustments rather than really big items of news. Having said that, those of you who can see that you are in fact affected by one or more of these new rules might well be feeling pretty indignant and might be thinking, well, how does it affect me? Well, the answer to that, of course, is come and see us here at Rowley Turton. Sit here in our boardroom where we're standing at the moment and sit down, have coffee and biscuits, and we can discuss it. But if you are one of those people, let's just go over who is mostly affected. And you can see a list there, and you might see yourself on that. So business owners are probably the first thing. And just recapping on something Scott said, if you have employees where you've given them flexibility on whether they have salary or pension, and you've allowed them to swap between the two or exchange one for the other, then you might be caught in this new salary sacrifice problem, which means that sacrificing too much of your salary in order to put it into your pension, or in order that your employer puts it into your pension, is now going to start being taxed in subject to national insurance. That doesn't just affect the employee, it will affect you also as a business owner, because you'll suddenly find you have to pay employers' national insurance, which following the increase last year is at 15%, on the amount you pay in. So that might be an extra bill for you as a business owner. And depending on how your scheme is arranged, you might find it difficult to unwind the pension contribution. And you might have to say to your employees, well, look, we can't pay that amount for you anymore. There's perhaps some employment law aspects there. So when Scott said a few minutes ago that you would want to look into that in advance of 2027, so a year and a bit, I think that's really good advice. Look into that in advance. The other thing, of course, is remuneration. We've said, Scott has told you that dividend tax is going up by 2%, from 8 and a bit at the lower end to 10 and a bit, and then up to over 35 at the higher rate. Well, of course, for a lot of people, dividends just means sort of the income it's generating for their investment. But for business owners, this is something that means their daily bread, because a lot of business owners pay themselves partly by salary, PAYE, and partly through dividends. Now, it's always been the case for a long, long time that small business owners especially tended to pay themselves a modest salary and then take most of their income by dividends. And being the owner of the company and sometimes the only employee, that's very easy to do. And it's always been the most tax efficient way of doing it, and that's fine. But that is becoming less and less the case. So you can see on screen there that at the basic rate of tax, so for PAYE, that's 20%. When you work out the overall burden of all the taxes that apply on this, that's dividend tax and corporation tax, national insurance and income tax, then in the basic rate band, so that's up to £50,000 roughly, it is still an advantage for business owners to take their money via dividend, not through salary. So that is still the case. But look, you can see now that in actual fact, for the first time, I think, once you've got above £50,000 a year, it's actually slightly less tax effective to take dividend than salary. So I think an awful lot of people for very many years have automatically taken most of their earnings as dividend. Now might be the time to speak to your accountant and say, well, look, now, is this still the best way to do it? I'm disadvantaging myself perhaps by about 3% on the money in the high rate tax band. Perhaps we should change how we take money from the company. Now, there are advantages and disadvantages, not quite as simple as I've explained it there. And that's especially the case when it's a family company, perhaps a husband and wife or spouses can share the dividends between them. So that's a complicating factor, but it's definitely something to think about. and speak to your accountant or come to speak to us. So individuals and families, well, no very significant changes, other than, of course, most individuals and families are savers to some extent, and we've heard that not only is the savings rate, that for most people that means bank income, is going up by 2%. So no longer the same as your 20% basic rate tax on your earnings on a PAYE, your interest is going to be at a different rate. So a bit more complicated, but we can take comfort in the fact that it's not as complicated as a Scottish system where I think I now have 6 different income tax bands. So you'll pay a little bit more on your bank interest, as Scott told us a few minutes ago. And you'll also be able to shelter less of that money in your cash ISA. So it's not very good news on that front, but really it's not very dramatic news for individuals and families in that sense. Certainly nothing to do with your salary or PAYE, nothing will have to change. So when you see in the newspapers at the end of every budget, how will this affect what you take home in your pay packet? No changes really. So on the next slide, we can see landlords. Well, landlords are a group of people who have been the subject of government tax changes quite a lot over recent years, and frankly, quite a lot of the landlords that we speak to, and there are a lot of people have a buy-to-let on a small basis, or even 2, 3, or 4. I think it's fair to say, we'll probably agree that most of the landlords we speak to are pretty fed up because they feel there's an increasing burden of not only tax but also regulation, and there's more in the pipeline. So this will be a bitter pill for them to swallow. Their income tax on their earnings as being a landlord is going to go up again by 2%, and that's from 2027, so a year and a bit's time. So people will be pretty fed up about that, and they'll feel it's another sort of nail in the coffin of whether being a landlord and making money from rent is a good idea.
On
you want to comment on that?
On that point, we didn't put it on the side, but it was a thought we had just before we started the presentation. There is an issue where landlords that own the properties directly, less so if you're own it through a limited company, whereby a few years ago the government effectively capped the mortgage interest relief. So rather than offsetting it fully against the rent, they applied a standard 20% deduction or saving, which for basic rate taxpayers meant no real change, i.e. you paid 20% tax on the rent and you got 20% interest saving on the mortgage interest, so no real changes. But it certainly hit high rate taxpayers where suddenly they were paying 40% income tax on the rent with only a 20% income tax saving on any mortgage interest, not capital repayments. Our concern at this stage, and we haven't got a definitive answer, is that, or concern or expectation, is that the government won't change the 20% mortgage interest rate figure, and I think they'll keep it at 20%. That's my gut feeling. I'm not seeing anything to say they are changing it. And therefore, if they then put the rent up to 22% tax, even for a basic rate taxpayer, you've gone from a point where you're at least neutral, i.e. you were getting a full tax relief at 20% for the mortgage interest, to where now you're effectively making a 2% loss on that, i.e. paying 22% tax on the rent and only getting 20% relief on the mortgage. Now, this is a similar situation to high rate taxpayers have been in for a while, as I've said, because they were paying 40% and only get 20% tax relief. But it's now going to, if what we believe is going to happen does happen, it's now going to filter down to even basic rate taxpayers. So this might be, I don't know, a retired person with a state pension and one buy-to-let property, with a buy-to-let mortgage on it. If you own it outright, it's not a factor, but if it's mortgage and if it's if you're a rate taxpayer, then again it's even worse in a sense because you're paying 42% tax with only 20% mortgage interest relief. They may change that, they may clarify it, but my gut feeling as we stand here today is that it's an extra 2% loss on money that you're not even making in effect. So I just wanted to make that point because it was.
Thanks, Todd. That's a valuable addition. So, but just going on with our slide there. So just to return to what I said at the beginning of this evening, which is that it could have been worse if landlords are feeling pretty fed up. Well, there'd been no changes to capital gains tax, so that's a key thing. And we did fear that those rates might have been increased a lot, maybe even up to income tax rates. Also, no changes to stamp duty. So despite what the newspapers promised us were going to happen only a couple of days ago, no changes there. Inheritance tax, the next line down on your slide, not directly related to this, but those people who have both a home and a buy-to-let property might have been close to the inheritance tax limit anyway. But now that inheritance tax is going to be levied on pensions as well, an awful lot of people who have more than one property, their pension will be the straw that breaks the camel's back, and that will put them into the inheritance tax paying bracket, I would have thought. And again, that's from April 2027. So the last point on this slide is just saying time to exit, question mark. And that's a point which we're asking our clients, and our clients are asking us. And the conclusion of a lot of quite disillusioned landlords is, well, maybe the time of investing in buy-to-let properties has had its time already. It's gone. So come and speak to us about that, and we can talk to you about alternatives and how to change things. So conclusions then. The conclusion is really just to recap on action to consider for business strategies. For business owners, think about your remuneration strategy, how you take your money from your business. This is something where you can really make a difference to what tax you pay. We all want to pay no more tax than we have to, and that's an area where you can affect that. Income tax position. If you're paying extra money on your savings and you're paying extra money on your rental income and you're paying extra money on your dividends, well, it's probably therefore time to think about how you can structure things so that you pay less tax than you are at the moment. There are various investment vehicles. ISAs is an obvious one, but also investment bonds and other vehicles that we can help you look at, which can help you manage your investment and manage your tax position a bit better. And that applies to business owners and also individuals with investments. Lastly, just again, repeating myself here, but landlords, I suppose the question for you is, do the numbers still stack up? So on all of this, how can Rowley Turton help? I think is the next slide. The next one, not the last one.
Okay, fine.
Which is what we do at Rowley Turton more than anything else, and first and foremost is helping you understand your financial planning picture. And we do that by planning, by looking forward, helping you understand what the possible future looks like, what your options are, and how the future might pan out. We try and use our crystal ball in a more sophisticated way than that, but we project forward and discuss how your financial planning might go over the years to come. We calculate what you need to do and how you need to get there. And we work in conjunction with your other experts, accountants, solicitors, etc., to help you navigate this world, of which this has been a quick whistle-stop tour of the latest happenings in the budget. Just lastly, we do this at the end of every webinar. Those of you who've been to a few of these will know that we offer a book. We didn't write this book, but it's something which nicely describes the principle we take in financial planning in terms of looking forward, helping you live the best life you can with your money, which is after all only a tool for living, and deciding and showing you how much money you need for the rest of your life and how to achieve that. If you'd like a copy of that book, which is an easy read and we like it, please let me know. Drop me an email at martin@rowleyturton.com and I will send you a copy.
Okay, thanks, Martin. One last point, just questions and answers. 1 second, here we go. Just one question, which is basically, given the tax changes and the IHT changes on pensions, which we talked briefly about today, but spoke about more last year when we did this, do pensions still have a place for people, or are they kind of old hat? I've always felt pensions are a great idea. The inheritance tax advantages they were enjoying and are still enjoying for a year and a bit, fabulous. And that going is a little bit disappointing, to put it mildly, but it still have a fabulous place. If we talk about the tax that small business owners in particular pay, and when you work out paying either corporation tax and then dividend tax if you pay the money out to yourself as dividends, or if you talk about the national insurance that you pay and then the income tax that you pay if you pay it through salary or bonus, as Martin mentioned earlier, we can get tax rates of 50% easily without really trying for most business owners, or certainly around 50%. Now, if we need that money, that's a necessary evil. We have to pay the tax because we've got money to pay for mortgages, school fees, holidays, etc. But if we are doing better than that and we've got money that we don't technically need today, but we will need in retirement, and we want to be funding our retirement, which I think we all should be considering, then pensions are an amazing vehicle, because effectively, in simple terms, what we can do is we take profits out of your business. Employees similar with wages, the maths are slightly different, but it's the same principle. But for business owners in particular, you can take that money that is going to pay some form of tax, potentially over 50% before you get in hand. So in some scenarios, you're seeing 45p in the pound in your pocket, and 55p in the pound is going to Rachel Reeves, in effect, for various combination of taxes that you will pay. Instead, you can put that into your pension. You can effectively keep every pound that you're earning. Now, yes, you will pay some tax when you come to retire, and that's not ideal. Nobody wants to pay tax. But for many of our clients, the tax that they will pay in retirement is only around 15%. So effectively, some clients can take a 55% tax saving today, only pay 15% in the future and get tax-free growth in the meantime. Effectively, we're a full 40% tax saving. So if you're making £50,000 a year that technically you don't need, and you're only going to see about 25,000 when you strip all the tax out, we can put it in your pension and effectively save tens of thousands of pounds, and over time, hundreds of thousands. So pensions are far from dead, and more of us need to be remembering that pensions are very good.
Thank you for that question.
Okay. Oh, another question. How have the markets responded to the budget?
Well, I think
Neutrally?
there was some concern. The response to this sort of budget is normally not the stock market so much, but the bond market, and that's to do with how much it costs government to borrow, and that's to do with how much confidence people have in the government to balance the books. There was a little bit of worry earlier on. The graph went down quite sharply, but then it recovered again. And I think the conclusion at the moment is that the international markets and the bond markets in particular are sort of, they're not too disappointed, they're not elated, it's sort of neutral. There are things to look for in a few years' time, because projections of government books are a bit uncertain. But at the moment, there've been no big reactions either way. So I think we can, bearing in mind what might have happened, I think we should take that as good news.
Yeah, I think Martin's point is good. That there was, the best you can say about this budget is that they could have raised the money they've raised in much worse ways, which is not much comfort, but it is some comfort. As Martin mentioned at the start, I do think it's a very disappointing budget in terms of growth. If you look at the business leaders and the small business people who get out of bed in the morning, go to work to kind of make money, they effectively are paying more and more taxes. And in simple terms, a lot of those, if you're paying yourself through dividend, we're now getting to the point where business owners are effectively paying higher tax rates than employees. And that is quite a change, because normally the tax system favoured you to run a business, favoured you to pay yourself for dividends. And partly this was because it was a reward for not only your hard work, but also the capital you employed, both financial, physical, and mental. So there was some idea that if you're running a business, yes, some of that money that you earn is down to just getting up and going to work, but some of it is down to the risk that you take. And the view was that you should be rewarded by the tax system by effectively paying a lower rate to encourage you and to encourage others to start businesses, run businesses, and grow businesses. With the most recent tax changes, i.e. the 2% increase and on the back of previous tax rises, I think we're getting to the point where for a lot of people, it doesn't necessarily make tax sense to run or to open or to launch or to expand a small business necessarily. And there are other reasons, obviously, self-control and the overall profit level is can be quite attractive to some people, but the tax system is no longer rewarding those people. So if you were to ask me, is it a budget for growth, for part of the supposed growth agenda? It definitely is not. It's, there's no real pro-growth elements within this budget. Things that you would have wanted to see if it was growth was perhaps dividend cuts, at least increases to the dividend allowance, probably corporation tax cuts, incentives for investing in business, and effectively, like even the venture capital trust income relief changing is a disincentive. So from that perspective, it is not a budget for growth. It's not catastrophic. I certainly 24 hours ago was running through all the ways that the government could kind of ruin my life and the life of my clients. The good news is a lot of the inheritance tax planning opportunities that we have started to use in light of the pension IHC changes, they are still all on the table, and that is a godsend. And some of the tax planning measures, we've got 2 cases we're working on at the moment where we're saving clients tens and hundreds of thousands in some cases on existing investment monies, and we worried that those planning opportunities would have been changed. We were desperately getting paperwork in before the budget. So I will at least sleep sounder tonight knowing that those cases are fine and those clients can still save that money so they can keep it. And like Martin says, if you've got any concerns about your own personal financial situation, or even if you think you're fine, you should probably still give us a call and we'll run through and just, worst case scenario, we'll confirm that you are in as good a shape as you thought you were. Thank you this evening. Just last point, I say we've got this IHT calculator. If you either email martin@rowleyturton.com or scott@rowleyturton.com, we can send you a link to that. It is on the website, but it's a bit awkward to find. It's easier to find on your phone, bizarrely. Also, if you want a copy of the Enough book, again, an email to Martin or me, and we will get one in the post. It's a hard copy, so we can't email that. So we just need your home address if we don't have it on file, or office address, and we will get one out in the post this week. Cheers, thank you, and good evening.
Thank you very much.